Sam Shaw, Senior Managing Director with Macquarie Capital, and I'm here with Justin Sadrian, who's a Managing Director and leads a lot of the software investing efforts at Warburg Pincus. How's Warburg thinking about investing?
The thing that I think we've been tried to be mindful of throughout both the run-up and today is making sure that we're getting dollars out or back to our investors as much as we are putting out the door. And we've managed to harvest more than we've invested in both 2020 and 2021, and multiple of that in the first quarter of this year. But for us, it feels like a good time to be a fundamental-based investor, as opposed to, say, a momentum-based investor. And for us, it falls back on first principles of investing that we've been focused on for decades. So what do I mean by that? Quality really matters in times like this. We're looking for A-plus businesses that have built market-leading or dominant positions in their category. Companies that have built wide moats that feel like they're going to be enduring not just today, but over years. We're focused on unit economics. The metrics matter here. It's about things like the retentiveness of a business, net retention, gross retention, logo retention. How much does this need to have versus nice to have? It's also about sales efficiency. How much does it cost to acquire a new customer? We're quite focused on quick payback businesses because in that dynamic, you essentially have today's customer financing the acquisition of tomorrow's future customer, which from a return on capital perspective is infinitely more valuable to an investor than going out for external equity capital to finance the growth or the acquisition of the next customer. So a couple of questions in there. First, on the public market pullback. For us, I'd argue that a lot of that pullback was warranted and a good thing for us over the longer run. The public markets have shown that they've been more discerning around quality. If you look at peak to trough across the public companies, the ones that have got hit the hardest are some of the slower growing ones. So it's about growth, but it really is around profitability. The ones that either aren't profitable today or aren't profitable and don't have a clear path to proving out their unit economics, they're the ones that have gotten hit really, really hard. So that's not to say that I think we're going back to a world of a quality SaaS software company trading at 4 or 5 times revenues. I do think there's been and will be a structural re-rating of valuations for high quality, say, SaaS businesses, given the growth and the durability of those kinds of businesses. But when you start talking about 40 or 50 times revenues for a business, even if one day you imagine that company will get to a 30, 35% profit margin, should it trade at 120 or 150 times EBITDA? It just makes no sense. And onto your question about the public versus privates, I guess I'd say we've started to see, we haven't seen it filter all the way through into the private markets yet. For the highest quality A businesses that are growing at a nice clip with proven unit economics, there's been some pullback in the frothiness, but not the re-rating you've seen on the public side. As we think about the companies that we've exited at the end of 2021 and into the first quarter of this year, we've been very happy with the valuations and the multiples that we've garnered in those businesses. There are 2 things that I'd highlight. For one, we're thesis-based investors, and we try and specialize. So there are 40 tech investors in the US, and we've organized ourselves in such a way that we have 25 focus areas, thematic theses. Roughly 2/3 of them are vertical, 1/3 of them are horizontal. And the idea is for this team of 2, 3, 4 people to spend years, if not decades, getting as smart as they can about a specific space. And the idea behind that is hopefully we show up with more than just a truck full of cash, and that we can be true partners to our management teams as we sit on the board and help them in their next leg of growth. The second thing that we've been particularly focused on over the last, say, 6 or 7 years is building out our ops or operational talent resources. That I think it's been easy for all of us to high-five ourselves on the way to good returns on the back of massive multiple expansion, buy low multiple, sell high multiple. The next 10 years, it's going to be all about multiple compression. And what's going to matter more is what everyone does the day after we've invested. And so for us, we've been building out a cadre of, we've got about 40 folks in the US who are experts at what they do and who are available to help them in their business building. And then bring this group of folks together and in an integrated way, so they're working in concert or in conjunction with each other, to provide a suite of services that if the management team wants, they can embrace. It's all pull. I think the push model doesn't work. If the CEO or even the CEO plus one layer down doesn't embrace it, it's not going to stick. So.
No, fascinating stuff. Well, appreciate the time.
Sure.
Thank you again.
Absolutely.